Welcome everyone, and thank you for joining us for today's webinar. My name's Karen Trout. I'll be your host today, and I look after investor relations for the Perpetual Credit Income Trust, or more commonly referred to as PCI. Before we begin, I just have a couple of housekeeping matters. To ask a question, please click type your question on the right-hand side of the screen. Please also include your name before you click send. We'll aim to go through as many questions as time permits at the end of the presentation. The presentation slides will be displayed on screen. You can also access a copy of the slides on the ASX website or our website at www.perpetualincome.com.au, and if you scroll down slightly, you'll see a link to the ASX announcements section. These will be made available after today's presentation. Turning to the next slide. Before we begin, I'd like to remind you all that this presentation is general in nature and to consider with your financial advisor whether the information presented today is suitable for your circumstances. Please refer to our disclaimer on slide 2. Today I'm joined by Michael Korber, Portfolio Manager of PCI and Managing Director of Credit and Fixed Income at Perpetual. Many of you would be familiar with Michael as he's arguably the most experienced credit and fixed income portfolio manager, given he launched Australia's first corporate bond fund in 1997. He's been investing for 39 years and been with Perpetual for 16 years. We're also joined by another Michael today, Michael Murphy. We're probably yet to think of a nickname for that. Now, some of you may not have heard from Mike Murphy before, but he's actually been with us for 4 years. Mike is our credit analyst and focuses on high yield and private debt markets. Prior to Perpetual, he was an investment associate at Metrics Credit Partners, analyst at Morningstar and CBA. So fair to say, a very high caliber and experienced team looking after PCI. So let's get into it. Turning to slide 4, the end of the 4-decade bond bull market. We see on the left-hand side the chart showing yields have been going down for the last 40 years, and that means bond prices have been going up. And we saw in the height of the COVID-19-led volatility in March 2020, a sharp sell-off in equity and bond markets. We've seen that retrace a little, but still a difficult market to navigate with a multitude of factors at play. So, Michael, what is happening in markets currently? And while we're on the topic, I might actually ask you to address a pre-registered question we received from Mark. So, Mark, thanks for your question. Mark has asked for your thoughts on the Australian economy corporate debt levels, rising rates, when do maturities start to roll over, and credit risks relating to these factors.
Thanks, Karen, and quite a comprehensive question there from Mark, so we'll try and cover that. Now, Karen, as you've said, look, the environment that we're looking at the moment is at the end of a very, very long period of rallying bond markets. So falling interest rates. We've had interest rates falling for 4 decades. That has come to an end, and it really does mark the end of an era. It's really hard to overstate how much decades of falling interest rates have consistently underpinned rising asset values in a lot of other financial and real markets globally. And structurally, those falling interest rates over the long term have encouraged an ever rising level of leverage in both corporate balance sheets and household balance sheets. And of course, over the last few cycles, we've seen risk being very heavily supported, almost underwritten, by central banks who've been, very keen to, prevent major catastrophes in markets. We've seen zero interest rate policies globally, a lot of liquidity support in the last couple of, significant market cycles. So at a fundamental level, we'd say that is coming to an end. The rally in interest rates has come to an end. It's not to say that they'll go back out to the levels that we saw historically, but the tailwind that those consistently falling rates over decades have given markets has come to an end, and the central bank support and a lot of other geopolitical factors have, added to the risk around that through the emergence of inflation. So, I think the sort of markets we've seen over the past 4 decades, the next 4 decades or even the next decade will look different. In the short term, the emergence of inflation has clearly been a catalyst that's caused a reassessment of markets. Now, part of that has come through with the pandemic, but we're also seeing a lot of other geopolitical factors feeding into that. And while some of it is transitory, we are also cognizant that some of it is structurally higher inflation due to things like an increased focus on decarbonisation, some of the reversal of the benefits of globalisation that we've seen for the past few decades, the geopolitical risks that we're seeing emerging, primarily in Central Europe at the moment, but those risks are also rising in other areas of the globe, and just demographics. We're seeing an ageing population through most developed markets. So to deal with that, central banks in the short term have been forced to raise interest rates, and we, are probably in an environment where that will continue. Obviously, inflation is not going to be conquered very quickly, and markets are projecting an ongoing increase in underlying base rates. In terms of how that affects our portfolio, as a investor in floating rate portfolios, rising interest rates are a significant positive for these portfolios because it does flow through directly into the returns generated by the floating rate securities that are held in portfolios. And the other key return generator in our portfolio are credit spreads. Now, credit spreads have actually carried the bulk of returns over the past 5 or 6 years as underlying interest rates have been very, very low. So historically, that has been the big return generator. What we've seen over the past year or so is that the margins in credit markets have increased quite a lot. So they've pushed out, from relatively tight levels to levels now which are wide of historical averages. And so both of those factors, higher floating rate interest rates and increasing credit margins, do flow positively through to the sorts of returns that the securities that we invest in can deliver to our portfolios. So moving to the next slide, slide 5, titled, "What are we seeing in the market?" We do think that in the short term, the outlook is challenging, and our view on credit spreads is negative. So we would expect to see a continued widening in credit margins, and we've obviously seen a significant increase in underlying interest rates over the past 12 months or so. And, the Australian 10-year bond yield at the moment is about 5.3%, 5.4%. 12 months ago, that was 1.7%. Corporate bond index, it's increased to 3.39%. 12 months ago, that was 1.1%. So we've seen a fair bit of change there. Probably the thing that's changed the least is actually the cash rate, which has only gone from 0.1 to a spread of 0.35%. But, we'd anticipate that continuing to rise in the short term. So these are real headwinds for markets. We're clearly seeing slowing economic growth. The impact of inflation and the risk aversion that generates is beginning to increasingly impact market sentiment and markets. And that's sort of underpinned by the accelerating tightening in monetary policy. So with a clear increase in uncertainty in markets, investors are holding elevated levels of cash, and we're definitely seeing market makers being more hesitant and more selective in trading books of assets, and liquidity in markets is definitely weaker than it was. Adding to that, we've seen supply increasing into markets, so bond issuance has increased. Part of that is due to the roll-off of central bank support for the banking system. We've seen a lot of bank paper being issued into the markets, and that combined with fragile demand conditions has led to weaker liquidity, rising credit margins. So we're dealing at the moment with a challenging market outlook. The key question is, where does that most impact? And historically, risks to the economy from tighter credit conditions and rising interest rates have flowed through to longer duration assets, things like commercial property, more so than corporate debt, where lenders, have got an eye to the firm's cash flows rather than the fixed value of assets underpinning lending. And that's one of the reasons, for example, in China, property-related debt is something that is disturbing in terms of global risks. Having said that, lenders, the largest lenders, are definitely better capitalised, better structured than they were in the period of the last major crisis in 2008. And obviously, central banks are very sensitive to the impact of policy on housing markets and consumer stress. So, we see a challenging environment, rising interest rates, widening credit margins, and that for a floating rate portfolio such as the Perpetual Credit Income Trust, ultimately generates greater return opportunities, and market volatility, is something that does provide opportunity for well-positioned investors. And the team at Perpetual have been successfully investing in credit markets in Australia for decades, and we have seen a lot of cycles before. And traditionally, volatility does increase opportunity. So turning to the next slide, slide 6, how are we currently positioned in this environment? And so, first environmental factor, rising inflation, potential for further interest rate increases. Well, floating rate investments do provide good protection against rising inflation because the returns within those portfolios will rise, will float upwards as monetary policy is tightened and cash rates rise. And so PCI is likely, in our view, to benefit as interest rates do rise because the interest payments, the distributions that we receive from our underlying assets will increase with those rises in interest rates. In terms of sector, our view is that sectors where you have long duration assets such as property and underpinning that financial lenders are much more sensitive to these monetary policy changes than well-positioned corporates. So the core holding in our portfolios are large corporate businesses, and we're very heavily weighted towards and specialise in investing in Australian corporate credit across various sectors, resources, consumer discretionary, utilities, software services, healthcare, transportation. It's a very broad, but broad exposure to large corporates with sustainable and significant cash flow. And we are very active in the way that we assess our exposure to these different sectors. We adjust our allocations quite actively. And because of the breadth of the investment universe that PCI does have, it gives us a very strong opportunity to avoid risk. We're not captive, for example, to particular sectors or particular positions in the rating spectrum. We do move the portfolio in a manner that minimises risk, but at the same time maximises the opportunity to generate good returns. And so, as credit spreads, continue to widen, which is our expectation at this point, and seeing volatility and some negativity in markets, we have positioned this portfolio quite defensively. So the weighted average life of the portfolio is only 3 years, which is to say the average asset matures in a 3-year period, which does insulate the portfolio quite a lot to widening credit spreads, but it maintains a really strong running yield and a potential distributable income for the portfolio. So the real objective that we have in this fund is to pay distributable income in a regular and significant manner, a predictable way. And we have a very strong process for identifying issuers which are very high in quality. So we are consistently investing only where we have high conviction, where we've done significant research, both at a broad industry level and into each of the issuers that we invest in. We're looking at strong balance sheets, really robust recurring earnings and cash flows. And, those are the sorts of businesses that can actually trade very successfully in challenging environments. And, as the senior debt holder in most of these businesses, we get first call on their cash flow. So we're very comfortable with the positioning there. Having said that, one of the great virtues in fixed income is to be well diversified. So this portfolio is extremely well diversified, over 100 assets across 92 separate issuers, a breadth of industry exposure, which I'll go into in a moment, in a little bit more. But also because, we have got an elevated holding of cash at the moment and a relatively short average maturity in the portfolio, we're very well positioned to capitalise on buying opportunities as a result of the recent widening that we've seen in credit spreads.
Michael, and we talked about portfolio running yield, which I believe is about 4.0% in the portfolio right now. We talked about floating rate exposure being beneficial in the current environment. A common question that we get from our investors is the percentage of the portfolio in fixed rate versus floating rate bonds. So can you tell us the split between the two and how you hedge the fixed rate bonds back to floating rate notes?
Yeah, so the portfolio is run in aggregate as a floating rate portfolio. In a compositional sense, a little bit over 1/4 of the book is actually held in fixed rate securities and bonds, and all of those are hedged back to a floating rate basis, primarily using futures or swaps. So yeah, the exposure to rising interest rates in this portfolio is, we're not negatively impacted by rises in interest rates. We actually see a positive flow through because the base coupon that our securities deliver to us rises as interest rates rise.
Thanks for that. And a reminder that you can submit your questions by clicking type your question on the right-hand side of the screen. So let's drill down into the portfolio a bit further. Turning to slide 7, portfolio composition. Michael, do you want to take us through what the portfolio is currently holding?
Yeah, so look, what we're trying to focus on when we construct our portfolio is to maximise the opportunity for generating high levels of returns in a very safe manner, and we do that by investing across the entire fixed income universe. So we're investors in everything from senior bank bonds and government bonds through to the bread and butter corporate bonds that we see in the ASX 200 or whatever, and then selective exposure into high yielding opportunities, either sub-investment grade bonds or private debt. And Michael Murphy will actually run you through a couple of examples of that in a few moments. So in terms of the portfolio, we control risk, by that diversity, combined with extensive research and analysis. And in terms of the sorts of things that we look at, there's some examples here. We look at how the portfolio is diversified by credit rating, by currency, by seniority, where in the capital structure we sit, and also by the breadth of industry sectors that we invest in. So if you look at some of the data examples that we've given you there, by rating, this portfolio is currently about 45% investment in investment grade securities, of which about 7.7% is cash. Our cash holding at the moment is at a relatively high level compared to history, and our exposure to non-investment grade assets is actually well below the limits that the fund is structured to permit. So a fairly significant investment grade holding at the moment. About 40% of the portfolio is in unrated assets. They would primarily be things like private debt that Michael will talk to you about in a moment, and about 14.8% of the portfolio is in sub-investment grade bonds. And those sorts of issuers there are large businesses. So Mineral Resources is an example. The LBO of Analyst, MYOB, those kinds of businesses are focus in the telco sector. So diversified, high quality in terms of credit rating. By currency, we are an investor focused on Australian assets. So the overwhelming majority of our obligors are Australian issuers, but we do look at their issues on a global basis. So particularly in periods of volatility, there's often opportunities to invest in assets in currencies other than Australian dollars. So you can see by that chart at the moment, about 83% of the assets are directly held in Australian dollars, with a holding in a range of other currencies, and that really is one of the strengths of this portfolio, Australian focused, but with a global outlook. Having said that, where we do hold assets which are not domiciled in Australian dollars, they are always fully hedged back to an Australian dollar floating rate basis. The third pie chart there just looks at the portfolio by seniority. Now, we do focus on senior debt, particularly as we move into some of the high-yielding assets. Being the senior debt holder, obviously, in a significant business with good cash flow, puts you into a very, very secure position, even in periods of market stress or potentially recessionary environments. So the overwhelming majority of the portfolio is invested at the senior level. As we move into major financials, we do invest into subordinated debt in that area. We don't invest much further down the capital stack, so we've only got small selective exposure, about 8% of the book, into things like hybrids and junior notes in things like asset-backed securities. And as I said earlier, the average maturity of these assets is 3 years, so very short average maturity. And just moving to the next slide, what's the next slide? 8. Next slide 8, which is portfolio composition by industry sector. And you can see from the chart on the left-hand side that we've got a very widely diversified portfolio. A bit over half of the portfolio is invested in corporate issuers, mainly Australian corporates, across a very wide variety of sectors and industries. And then we have significant exposure into a range of other sectors. So, in the banking sector, which is around about 7% of the book, names like Macquarie Bank feature. In the finance sector, Suncorp Group is an example. In the property trust sector, we have exposure to names like Scentre Group and Lendlease. Drilling into the more into the corporate breakdown, so that's the half of the portfolio which is split out on the right-hand side, the breakdown by corporate sector. You can see we are very widely diversified. Having said that, areas that we don't invest much into are, long-dated assets that aren't cash flow generating. So, we don't have exposure to direct property. We have very limited exposure to long-dated infrastructure. And just to give you a bit of a flavour of some of the holdings within, that huge array of industry sectors, we start off with airlines, so we have an exposure there to Qantas. Chemicals, Incitec Pivot. Commercial services, Iron Mountain, which is a data storage and management company. Software and services, MYOB. BlueScope Steel in the industrial sector. Santos in the energy sector. Woolworths in supermarkets and pharmacies. Optus and Vocus in telecommunications. So, widely diversified, high quality, and a real focus on corporate risk, which we think in a challenging environment, the cash flows that are a feature of solid corporates is really the place to invest in challenging environments. And we focus on being active and we focus on being diverse to manage that risk and really to lock in the ability to deliver consistent income distribution to our investors.
Thanks, Michael, and some good examples there. Before I get Mike Murphy to showcase his example of a high yield asset, I might just ask Mike to outline why we like investing in the high yield space. So we have just over half the portfolio in high yield. So what are the opportunities in that space?
Thanks, Karen. We've been investing in high yield space for a number of years now. High yield is a key way for us to enhance the portfolio as it provides high coupons and capital stability as we generally invest at the top of the capital structure. This means if something goes wrong with the issuer and they are wound up, we are the first to be repaid.
Yeah, absolutely. So getting into that example on slide 9, SCF Group, let's start with the features. So what is the type of asset we're invested in? What's the credit rating of SCF and where does it sit in the capital structure?
Okay, so SCF are an unlisted Australian company. The term loan is unrated. This is often the case for private debt deals, as they are targeted to a small group of institutional investors who do their own credit work and therefore do not require a credit rating. The term to maturity was 3 years, which is in line with our short duration credit goal. It is senior secured, meaning that the lenders have security over the company and first priority on payments.
Yeah, thanks. And just to add to that, I think SCF is a really good example of an asset that's difficult for retail investors to access. So as Michael mentioned, we have a very broad investment universe and it's flexible to allow us to adapt to changing market conditions. But I think another good point is that retail investors wouldn't normally have access to an asset such as SCF Group. So we're really bringing an institutional grade product to retail investors that's available on the ASX. So looking at what SCF does, Mike Murphy, can you tell us why it's a compelling investment?
Okay, so SCF Group provides leasing of specialist containers to blue chip companies across a number of end markets, including road and rail transportation, construction and mining. The containers are used for transportation of goods by road or rail, storage and portable accommodation. Their fleet of containers are customized to meet the requirements of the end user. We like this issuer because they have a great industry outlook, a strong competitive position, a diversified blue chip customer base, revenue visibility from term leasing contracts, which provides strong cash flows and give SCF a comfortable ability to meet their interest payments. The deal also had a good structure with increased restrictions on SCF Group to maintain their ability to meet loan obligations. The interest margin offered on the deal was also attractive, both in absolute terms and compared to recently priced deals in the market. SCF Group is a good example of what we are looking to achieve in the high yield space, undertaking an extensive due diligence process to screen issuers and identify the most attractive assets, providing high income on debt from an issuer with sound fundamentals.
Thanks, Mike. So turning to slide 10, looking at our distribution and performance. So the top table shows the monthly income that was paid, and you can see the distribution increase over the last few months, particularly starting in December last year, and that's attributed from our strong income return. And the recent increase in the RBA cash rate will also support the higher distribution. So at the end of April, our annual distribution return was 3.7%, and that's above PCI's target return of RBA cash rate plus 3.25%. Performance-wise, we believe in long-term investing, and over the 1 year, we've seen PCI deliver 2.4%, outperforming the benchmark. And we know many of you listening today have been with us since inception, and we thank you for your support. Since inception, we've delivered 3.4%, outperforming the benchmark by 1.2% and achieving a distribution return of 3.5%. So turning to the next slide, we've heard a lot today from Michael and Mike Murphy, their insights on markets and how they're currently investing. I think this slide neatly summarises PCI's offering. So monthly income with a target return of RBA cash rate plus 3.25%. And I mentioned earlier about the increase that we've seen in that of late. We're specialists in Australian corporate credit. So both Michael, Mike Murphy and the broader credit and fixed income team at Perpetual, they have deep experience in investing. We have a strong focus on fundamental research to identify attractive issuers and assets on a risk return basis. So as Mike mentioned, we look for issuers with a good balance sheet, predictable cash flows, hold a competitive market position, have capable management and low susceptibility to regulatory changes and political risk and other event risks. We're likely to continue to see market volatility, so we do believe that's where active management can be a real advantage. So we can adapt our portfolio to the changing market conditions, and we place a heavy focus on researching our issuers, managing credit risk, and holding a diversified pool of assets. So at the end of April, the portfolio had 118 assets across 92 issuers, and that's above our typical range of 50 to 100 assets. And I think that's good for diversification, and it really highlights the relative opportunities that Michael and the team are seeing. A feature particularly important in the current environment is that PCI has floating rate exposure, and Michael spoke a lot about this earlier. We see PCI being a beneficiary of this as interest rates go up, and that's because it's better protection against inflation than fixed rate bonds, and the interest payments we receive from issuers will also increase. And lastly, PCI is a listed investment trust, so investors have access to liquidity on the ASX. We release PCI's NTA daily, so that promotes transparency and it shows the value of the portfolio. And we believe there's currently an opportunity with PCI to buy quality assets at a discount to NTA. So that concludes the presentation. We'll now move to Q&A. I can see we've received quite a few questions. Our first question is from Sasha, and I'll direct this to Michael. What's your rationale to hold at this point in the credit cycle and dislocation?
Yeah, so we've been asked on occasion, is this the right point in the credit cycle to actually be invested in these assets? And I think the answer to that is that we've already seen quite a lot of movement in credit margins. So a lot of the credit cycle widening has already taken place. We've seen credit margins close to doubling in a lot of sectors, and the portfolio has been very well shielded from that by that combination of short average life and high running yields. So I think it's probably too late to try to time the credit cycle because we're already halfway through it. The portfolio has been shielded, and at this point in time, we're actually seeing the benefit of the opportunities that it throws up. So we're seeing a lot of opportunities to invest, much wider than at spread levels much wider than we'd seen 12 months ago. And really, the way that we invest is to be very active. So to shield the portfolio from periods of time where we think spreads will widen. And to be in a position then to take advantage of that. And we are just beginning to see that. So we're still in the situation at the moment where the portfolio is defensive and it is well shielded from credit market volatility. But at the same time, there's just an increasing flow of investment opportunities. So we think that going forward, that combination of wider credit margins, and really it's only up until last month that the short end of the interest rate curve has been pushed higher, courtesy of the RBA. So those two things will actually, mean an increase in opportunity, much greater, I think, than the sort of volatility risk that we will definitely see in the short term.
Yeah, thanks, Michael. And I think a nice segue into our next question, which I'll direct to Mike Murphy. How comfortable are you with high yield given the economic challenges?
Thanks, Karen. In response to that, I'd say that we only look to invest in high yield issuers where we have a high conviction after doing intensive research on the issuer. So if we don't have conviction in the investment, then we'll invest in other asset classes like investment grade. And when we do the work, we look to hold to maturity. So we're kind of sensitizing our assumptions to a full economic cycle. So in our intensive research, we'll do things like sensitize our forecast to higher interest rates and see that we're still comfortable that the issuer can meet their debt obligations, and we'll look at taking into account the economics of the industry they're in, their ability to pass on higher input costs and those sort of things. So that's something that we really take into account when we look to go into these investments.
Yeah, maybe to add to that, Mark, that's great. The portfolio is a selective investor in high yield, so it's not a high yield portfolio per se. We invest in opportunities where we particularly like that opportunity. The core of this portfolio is investment grade, and we allocate capital out of investment grade where the opportunity really is compelling. We're not forced to take that risk. And as Mike has highlighted, we do a lot of research. We invest into really robust issuers in that space, who are resilient to changing economic conditions. And it's just that sort of ability to cherry pick really the best of that asset class, I think, is a real productive feature of the way this portfolio is constructed.
Yeah, I think that also relates to a question that we had from John Thompson, who asked why we have such a small proportion in A-rated assets. And I think that does go back to kind of this portfolio being best ideas. We're attracting, we're finding a lot of relative value opportunities.
Yeah, Karen, I think that's right. And also, if you think about it, if you look at the majority of Australian corporates, the real leading businesses and brand names in the Australian marketplace, they are not A-rated. corporates. Their efficient capital structure is to be BBB rated. And so that's where the overwhelming majority of large Australian corporates sits in a rating spectrum sense. And of course, the return objective of the portfolio really, it does have to look for coupons that meet our objectives. And, as you move into, the very high end of the investment grade, you tend not to see that. Having said that, there are points in time, with a lot of volatility. We do actively trade at the higher end of the rating spectrum, particularly long-dated assets. We tend to avoid them at points in time like right now, where we see spreads widening and, long-dated, low-coupon, highly rated corporate bonds do not perform. They perform poorly in that environment. And conversely, once we've seen a shift in markets and spreads are much wider, then those sorts of assets can be really attractive, and you'll see a shift, out the maturity spectrum into higher rated credits where you actually get, leverage to contracting spreads. Ironically, shorter dated, BBBs and high yielding securities are actually less risky in terms of market volatility. And that's where we want to be in an environment where we see spreads, potentially widening.
Yeah, thanks, Michael. We've received a question from Charmaine. She asked, what is your best 3 to 5 fixed interest investment in the current environment?
Great question. I don't know that we want to share stuff like that online, do we? But yeah, look, it's interesting because if you look at the way the book is structured, it tends to be concentrated in that sort of 3, maybe out to 5 year maturity, because, as I said in the previous question, it is defensive. You get high running yield and you get relatively low susceptibility to spread volatility, spread widening. Now, what we've seen of late is, with underlying interest rates pushing out, even government bonds in the 3 to 5 year part of the curve are paying above 3% interest rates. We recently invested in this portfolio. It's an ANZ senior paper that was issued in the 3 year maturity at above 4%. As a single asset investor, you can't afford to take a lot of credit risk because you have no diversification. So they're the sorts of things I think, make sense on their own. But having said that, those sorts of investments are probably at the very tight end of what we'd look to invest in. So I think, that really highlights the real opportunity that you do get investing into, an active and conservatively run credit portfolio like ours, because the opportunity set, on a diversified basis is much wider than that. And particularly, as Mike highlighted, we see some private debt opportunities which are just really compelling and offer return, numbers much greater than that.